What's up, everybody? Michael and Coco here to do some technical analysis on the financial markets. The week just came to an end. A lot of curveballs being thrown. Have a lot to go over. I'm going to keep it simple, talk about some psychology and the patterns that I see, and kind of just try to get a good sense as to where this market might be headed next. Let's get into it. Welcome back. We are looking at the S&P 500. We're going to start here on the weekly time frame, and then we're going to go into some other charts. We'll probably look at the monthly, the lower time frames, just to kind of get a good sense as to what's going on everywhere in these markets. So first things first, I want to look at the weekly chart on the S&P 500. If you've been following me for quite some time, you've probably seen this megaphone pattern. If you don't follow me, you've probably still seen this megaphone pattern because a lot of other technicians have been drawing it out. One thing that I'd like to call out for the week is the current candle, how it closed and where it closed at. So if you take a look at this small dash line kind of running up, and if you need to see a more high-depth view of this chart, you're more than welcome to go into the description, and I have all the charts that I see. I update them all the time, and you could watch this from your own computer, from wherever you want, and you could kind of just see it from a bird's eye view instead of just on this YouTube video. This trend line has been kind of forming since June, and we bounced from it right here, we bounced from it right there, we came back, retested it, finally broke through, and then we broke through again, and now we're retesting it. So this week, what I'm trying to say here is, at a time in this specific week, this candle right here looked like one big bullish green candle, just a big monster green candle to the upside. And a lot of bulls, okay, you got to think of the psychology of the bulls here, were probably thinking, hey, because of this hammer candle here, we're seeing this bounce, we can get a continuation to the upside. However, it came above this resistance that we mapped out previously, just a little bit above it, and people got pretty excited. Then the bears, they really stepped up. So think from a bull's perspective here. All the bulls were buying it up and lifting higher and higher. And then all of a sudden they get through this resistance, they're feeling good, and then the bears step in and they start pushing the price lower, which would represent trapping a lot of bulls in this trade. So how do you think the bulls are, or the people that were buying into this momentum to the upside, whether it be calls, just regular, just equity purchases on various different stocks? How do you think they feel when they were buying at the top of this resistance because they didn't realize that there was resistance right here? Well, they probably feel very anxious, very nervous, because the price from there started heading a lot lower. This candle is known as a shooting star. Shooting stars are very bearish in an upwards projection. So we bounced, hammer, that is a positive sign. Then boom, we bounce, and now we're seeing weakness. This looks like a dead cat bounce. Dead cat bounces, they pull down, they show signs of strength. We saw the strength, and then they show signs of weakness. But it could take, a long time for that to play out. However, and it comes with, a big overarching, however, you need to see confirmation on these inverted hammers. Okay, so I've seen this in many trades, in many tech stock trades, where it shows an inverted hammer in a nice upwards direction. It looks like it's going to start falling, but then all of a sudden something takes place and we just see a blast to the upside. So it's always important to see the next week's trading candle either close below it or trade under it, because then you could posture yourself for a position to go short. That would make technical sense because it's a good risk versus reward trade. If you start seeing it trade lower, you can enter short, and then you can have a stop loss above the previous daily candle, weekly candle, whatever you create as far as your trade plan goes. Now, the two squiggly lines here, this green one is the 20-period moving average, and it clearly acted as support on the previous week. We bounced from it, and boom, we came up. And now we're kind of just sitting at the 5 EMA. And the EMA, the 5 at least, is a very frequently tagged moving average. And right now we're just sitting right there. I think the price is actually above it, which is a decent sign for the bulls. So we closed at 3348, and the EMA's at 3342. So yeah, just slightly above it. It's not nothing crazy to consider quite yet. Now, couple things that I want to point out are the two indicators. We have the RSI and we have the MACD down here. The RSI is the negative divergence. What does this mean? Well, this is not good for the bulls. That means there's more risk to the upside than there is to the downside. So if you, in short, if you start buying right around these points to go long, it's not the greatest risk versus reward trade because you would need to see breakouts and just a lot of momentum to the upside. And you can see the RSI put a really big high in right here at the all-time market high. And now we're even at a higher high over here, but yet on the RSI, it was a lower high. So that is a negative divergence taking place. The MACD is showing strength. However, keep in mind where it's kind of curling off right here. So we're seeing a big drop off right here, and it looks like we might start getting some sort of bearish crossover. Now it's way above zero, so that doesn't mean the trend is completely changing, but it is something worth noting. Here's the monthly time frame. Won't spend much time here. This is for the S&P 500. You can see the negative divergence in the RSI, and you can actually see it in the MACD slightly too as well. You see it was actually higher here when the price was lower, and it's a little bit lower here, not by much, but as you can see, it does go lower, and then the price action is significantly higher. Then you have to wrap in these two candles here. That's dark cloud variation. So the start of October for the S&P 500 is down 0.5%. Not really, that big of a deal. We are disconnected from the 5 EMA, so it's likely that we go retest that level here in the near future. That would put us right around 3,300. So it's going to be interesting to see how this month plays out. As I've been saying, this whole setup here looks quite bearish. I am personally more of a risk off in this certain environment than risk on at this particular point in time. Things can change. We can have some sort of news happen, whatever the case may be. But when you look at seasonality and then you tie in with the presidential election and then you tie in some other stuff that's been obviously going on, the president just got COVID, which is, I'm surprised that the market kind of held itself together for the most part, other than all the market chop. But all of these are kind of a cocktail for increased uncertainty and potentially stronger moves to the downside. So, if the market starts roaring up, you want to be part of that trade. But if it starts falling down, you got to be prepared for that type of move to happen. Here is the S&P 500 on the daily time frame, and the thumbnail that I drew out yesterday and I discussed on the market brief was this kind of looks like a bear flag. This is obviously the falling wedge, and we're still kind of monitoring. I haven't really updated this chart because it's still kind of relevant here at this particular point in time. What I want to kind of walk through right now is the recent candles that have been forming. So really we've been just going sideways for the last 4 trading days. However, if you look at the last 3 trading candles, this to me looks, definitely a variation, but an evening star variation, which is a reversal type pattern when you see a big uptick. Now, you can be very critical on this and, just basically say, no, that doesn't quite match up. But, you could also make the argument for this being very well an evening star variation. Now, the reason why you can argue that this is not a evening star variation is simply because this third candle right here out of these 3 should have more of a bearish type body, and really you're looking at a long upper wick, which could be bearish, but then you also have a lower wick. It's kind of matching. So if this was a red body, then this would suggest to me, yes, that makes some sense that this is an evening star. So I can see the debate back and forth, but the psychology of it is still really there. We have this big price advance, this candle here, and then we saw a big uptick, a gap up, kind of move sideways, created a little bit of uncertainty, but then we had a gap down, move lower, sitting right around the 5 EMA, 3348 versus 3348. Oh my gosh, so technically the EMA is just above it by a couple of cents there, so it's basically on it, and it's below the 50-period moving average. So we're seeing the leadership of the bulls take off, but then all of a sudden, out of nowhere, this gap down is showing some bears taking action. So this is typically a bearish type looking setup. So it's going to be interesting to see where the next trading day brings us. If we get a gap down, then you're just looking at like just an island reversal type pattern where we just have a kind of a gap and just this left up in the clouds somewhere hanging out. So it's going to be interesting to obviously see where this plays out. Now, the 50-period moving, fib level here is at 3397, so 3400, struggled to get above it. Doesn't mean it can't just get up there, but clearly having some resistance there. I was saying that I feel like the price action with some stimulus, actual real stimulus news, can get up to 61.8. That would make sense to me, and then you'd probably see some resistance up in that area. This is a well-watched fib level right here, so I would imagine that you would see some bears step up and some sellers take profits right there. However, if we start to continue downside and start moving down, if we don't get that stimulus or more bad news comes out, I think that the main target area still remains down here, right around, you know, the 200 period moving average, all the way down to 3,000. So it's quite the zone, quite the range, but you know, it's very, very likely and very, very possible to see that. Here is the VIX on the daily time frame. The VIX was up, obviously, just a little bit today. Red body, though. So it's still kind of within this inverse head and shoulders. I'm looking at this neckline right around here at 36. If we get above that, I think that our zone is definitely going to be up in this 50 range. We can see a big spike take place, and that could really bring the S&P 500 down to that 3,000 to 3,200 level. There's a lot of support at 3,200, so we're going to have to watch that one also very closely, but this is still holding within this overall pattern. It's going to be something that we need to pay close attention to. Not the greatest start for the Nasdaq 100 on the monthly time frame. We're down 1.42% already. We have the negative divergence in the RSI. This trend line we've been kind of monitoring. We saw some big drop-offs previously, and these two trading candles right here are not the greatest to go long in. And what we're seeing right now is an early start to confirmation. Now, we had a long lower wick here last month. So what we would have to see to really confirm a move lower down to this, say, next fib level would make sense, 38.2. That's a 9250 to 9500, maybe a little bit higher. I can see it bouncing around the 10,000 marker. But we would need to see some movements to the downside to make a new low to the previous. When we get confirmation like that, we can really be setting ourselves up for even more of a continuation to the downside. As I see it right now, bearish start. We had a little bit of a gap up, but now we're already lower than the previous monthly close. So we'll see where this one also goes. On the weekly time frame for the Nasdaq 100, we also have a negative divergence in the RSI. Our MACD recently did a bearish crossover, still way above zero. So take it with a grain of salt, still worth noting. And we have a shooting star candle right here as well. Now we do have the price action above the 5 EMA, so this, you want to wait for confirmation. Okay, so if we start getting closing lower, then yeah, I think that this is a very possible level to reach. This is at 38.2 fib level is at 10,284. Yeah, 10,500. That's very possible, but we need confirmation. Now, what makes this one very bearish right here is simply because it was once a big, very green candle all the way up to 11,600. And then the bears clearly stepped up, selling pressure occurred, trapping longs within the lower wick or the upper wick here. And then not only was it not a green body, the bears overtook the opening and closed on just about the low for the week. So that all right here to me looks very, very bearish, and it's very, very likely and very possible that we see a continuation to the downside. Mind you, if there is positive news, if there is a stimulus deal, which I don't think is going to pass now, but that I'm just speculating. If there's positive news, it's just perceived. You got to understand that how it's perceived in the marketplace is just as important than whether getting it or not. Because if the market perceives it, sometimes you can have the market move and price it in before it actually comes. So understand that. I mean, just take it, just think about that there's always a possibility for just a blast up higher. So, position yourself to really be able to profit from either if the market goes up or down. You need to be careful in these environments. As I see it right here, I mean, with the breakdown of this channel, with the MACD crossover, with the negative divergence, with this price action, yeah, to me, this looks pretty bearish. So, my view is risk off still. Here is the daily time frame, and this right here is an evening star variation. And what we stated the other day was the Bollinger Bands. Oh, I'm sorry too. Somebody said, can you make them darker? And I completely forgot to. I'm sorry. But the Bollinger Bands was contracting, and what we said was we can potentially see the price reach up to the Bollinger Bands and then get rejected. And as you can see, the price action for this day went to 11,600. The Bollinger Bands right now is at 11,641, so it got pulled down lower because of this candle. But as you can see that they're contracting, okay? And you see in the price action here, you have the bulls momentum to the upside, and then all of a sudden just a monster gap. The bulls tried to step back up, but then closed below the 50 period and the 5 EMA. That right there is very, very bearish technical pattern. Now we are still above the 20 period, so that's something to note. But if we see continuation to the downside, I would just be looking at this trend line, maybe a retest, 11,100. As we saw in the weekly time frame, we could pull back even lower. When you look at the MACD, we did have this bullish type crossover, but it was below zero, and now we're starting to try to cross back over again, which can mean that the daily momentum is really shifting back into bearish territory. This to me also represents a risk-off trade. I'd probably be very hesitant to go long at these specific levels. Here is the Dow Jones. The Dow Jones doesn't, it looks weak to me. But it doesn't look as weak as some of the other charts. And let me kind of walk you through my thought process here. We are above the 50, barely. We're above the 5 EMA, barely. We're above the 200. So, the context right now is, I would say that this context currently remains uncertain. Now, there's a couple things that I want to note. If you see the high right here, then you see another high here, and then another high here. What is that right there? Well, that is lower highs. So imagine stair-stepping down, boing, boing. All right, and then you look at the lows. You have a low low here, a lower low here. So right now, this current trend dating back to September 1st really is a bearish trend. You match that into the breakdown of this rising wedge. That is also bearish. Now, the reason why I don't think it's as bearish looking at some of the other charts is just where the price action lies on the context overall. But keep in mind the pattern here still looks kind of like an evening star, but we still have a green body right here, so it's going to be interesting to kind of see how this plays out. Now, what would change my mind about this? Well, my mind would change if we start putting in a higher high. So we would have to start, we'd have to put in a higher low. So if it pulls back and then bounces and then starts changing kind of the trend where we pulled back and now we're starting to readjust. That would look like an inverse head and shoulders. We would see a shoulder here, a head here, and another shoulder here. However, if you look back just a little bit more, you have a shoulder here, a head here, and a shoulder here. So a crack below this 26,500 level, or even just let's call it the 200 period moving average, that could be the neckline for a potential move lower. It's very possible, but we need to see how this price action currently plays out. As I see it right now, it looks like it wants to curl over. It would make sense to curl over, but we would need to see it actually happen. I want to quickly go into the smaller time frames of the S&P 500 and the Nasdaq 100 right now. First thing is the S&P 500 is putting in a head and shoulders type pattern right here. And it looks like if we get a crack below the 50 period moving average and this current gap window, I very well can see this breaking the neckline and heading lower. This type of pattern right here on a big move up is a bearish type pattern. Now we broke out of the falling wedge, and now we've been kind of consolidating sideways, putting in this stuff. Now, keep in mind that where the 200 period is, we've obviously had a lot of resistance right there, but it tried very hard to get above it and failed to do so. So on the last 2 hours of today's trading day, you saw it try to go for it for a third time, get rejected, and then close on the low of that candle. It looks like this shoulder is going to continue forming. Now, this blue line right here represents where the previous day closed. So if we start getting above that, we're going to have to reassess this pattern because it would be a failed head and shoulders to the downside. On a smaller time frame, 30 minutes, I threw this out on Twitter before we actually got the rejection to the downside. What I was saying was when the price came up, it looked like this area, it was going to struggle. Shortly thereafter, within the hour, we saw the fall down, we saw another attempt, and then we saw another rollover closing just about on the low for the day. Not quite there, but we did close on the low of this 30-minute candle. As you can see, kind of a head and shoulders forming right here, obviously, as well. So a crack below this neckline, filling the gap. Remember, this gap window, you typically have support at the window. So right here at 3310, 3300, it's very likely to see bounces take place from this specific area. So if we start closing down below that, it's very possible that this head and shoulders can head into even lower territory. I would say right around here at 3280 down to 3230. We'll watch how that plays out on Monday and Tuesday and through the rest of the next week. Now let's start talking about some breadth indicators and why I think we haven't really quite reached a bottom quite yet. Can I be wrong? Obviously I can be wrong, so you got to be prepared for either move. But what have we been saying about the McClellan oscillator, the breadth indicator? We matched it up to 2018, at least I talked about it. And what took place was in 2018, we reached an all-time high in the market, but we did so on a negative breadth. In 2020, we're seeing something very similar take place. In 2018, that's when we saw, in late 2018, we saw a big fall to the downside. Most tech stocks, the FANG stocks, went into bear market territory, even falling somewhat lower. I think it was 35 to 50% in some of those tech stocks. Now, the market made this falling wedge. It broke out of the falling wedge, and then what we saw with the NIMO is we saw a spike up, and then all of a sudden a spike to the downside. So right now we had this big breadth in the market, so it pushed higher. Very interesting. So now if we start seeing this start to head lower, that can very well send this market to a lower portion, which is the target we've been setting up, was that 3,000 to 3,150 or whatever it was, that pink box on the previous daily S&P 500 chart. This right here to me is signaling that get ready, because there is some momentum going to happen to the downside. Now let's take a look at a couple of charts that help to find market bottoms. This is the high-low index, the Cohan Nasdaq high-low index. And what I just want to simply put here, instead of walking you through what exactly this is know that when the price action on this chart reaches down to these levels, it's really good at finding market bottoms. Now, it's not always 100% accurate, but you can say that when it reaches these levels, the market gets overextended to the downside and you see some rips to the upside. So right here in March, you saw it spike down, boom. Here in 2019, or going into 2019, from 2018, we saw it spike down into this level, boom, it hit its bottom. Right here you can see something very similar, but it wasn't quite there yet. It went a little bit lower and then started moving higher as well. So we're far away from this level, but if you want to know when a market bottom seems to be setting in, it's good to look at this chart, because if we're down here, chances are the contrarian indicator would tell us, hey, it could be a time to go long at this particular point in time. This indicator is the Pring Bottom Fisher. This helps to find bottoms in the market as well. And as you can see, we crossed through this horizontal black line. We're still sloping down. And when the blue line crosses above the green and the blue start to both move ahead, just head up with each other, that's a good sign that the market has found its temporary bottom. This indicator as well is not a holy grail. There is no holy grail indicator, but we can start to put things together when we start believing that the market has bottomed. As you can see here in March, it acted just perfectly where it crossed above, started heading higher right around the market bottom. We saw a very similar thing take place also here in the 2018 going into 2019. Didn't time it perfectly, but it did map it out quite well. So you can pull this chart up, kind of play around with it, see what took place. And if we do start to see this crossover, that could be very well a signal saying, okay, we might start heading a little bit higher here. Here is the bullish percent index for the NASDAQ 100. This is using point and figure charts. And really what it tells us is, when whatever number it's on, it tells us the percent of stocks in the NASDAQ 100 that are on buy signals versus sell signals. So right now we're 59% of the stocks in the NASDAQ 100 are on buy signals. When you look at the point and figure charts, that means the other remaining portion are on sell signals. Now, what you can do with this is you can map out positive and negative divergences with the RSI, and it gets a good indicator as to what might be taking place next. When you look at the NASDAQ 100 right up here, notice on this chart you had a low here and then a lower low right here. However, on the RSI, you had a low here and a higher low here. That right there was signaling, especially when we were in that falling wedge, a bullish divergence. And what did we see take place? Well, we saw not only a spike up here in the RSI, but we saw a spike up in the NASDAQ 100. So the indicator told us that, hey, we might be seeing this move up in the near future. Well, we saw this spike, and now we're starting to get some momentum to the downside. I don't see any other divergences at this particular point in time, but what I do see is this pointing downwards and very well might likely slope past below the 50. If it slopes below the 50, in simplistic terms, it's basically saying there's more bearish sentiment than there is bullish sentiment. But at this particular point in time, we're looking at a chart that has more bullish sentiment over bearish sentiment. Now I want to do a couple ratio charts just to give a good sentiment on where prices are shifting to. And on the last videos we discussed where prices are kind of shifting to that I've noticed in September. We looked at a sector map of the S&P 500 and we noticed that there was a lot of money flooding in to utilities. It was one of the only sectors that was positive in the month of September alongside consumer discretionaries, I believe it was. So what do we got going on here? First off, we're looking at utilities over the SPY. So when the ratio goes up, that means utilities outperformed SPY. This blue line is the 13 EMA, and it's just a good trend indicator. As you can see, we get whipsaws back and forth, but just notice that when we see these sharp inclines and it goes above the 13, chances are there's a lot more momentum heading in to that sector, whatever one that we're looking at. In this one, we're looking at XLU, which is the utilities sector. Okay, now why is this important? Well, the utilities sector, people tend to move into that sector for safety. Okay, it's about electricity, it's about a lot of water, and it typically does decent or not as bad as some of the risk on sectors that we usually look at or compare to. So when utilities does well, it means that investors could potentially be seeking safety in lower risk assets. It's a risk on to risk off move. And what do we got going on here? Well, this is the weekly chart, and we're seeing a big spike to the upside crossing above the 13-period weekly average. This move in the upwards direction makes me think, hey, very likely that we're seeing a big shift or potential big shift from risk on to risk off. This right here is TLH over the SPY. This is a ratio chart. We're looking at 10 to 20 year treasury bonds over the SPY. So when you see this go up, people are moving into safety assets and security, risk on to risk off. And then when you see the ratio go down, that is when people are going from risk off to risk on. We're moving into equities. What do we got going on here? Well, I'm looking at it on the daily time frame. What I want to point out is on the daily time frame, it looks at this particular point in time that the trend potentially might be changing. We saw a little bit of an uptick today. We're still below the 13-period EMA, but what I want to call out is the higher low that it did put in. So if we continue that momentum and we get above 53 here, then we're putting in a new higher high, which could signal a shift in sentiment from risk on to risk off. This is the early start of a potential trend reversal. As you can see here, when we crossed above the 13-period EMA and we started to see the market decline, where did investors seek safety? We saw a huge spike in the 10 to 20 year treasury bonds. Let's quickly discuss silver, gold, and Bitcoin. I'll start with silver today. This trend line, it's holding. Silver, it's looking shaky on this ground. We got to get back above 24.5 to maybe put in, a new high right here to break out of this current bear flag. Now, we've seen that happen with Bitcoin where we saw this pull to the downside, jumped up, fell down, and then finally broke out, but then still struggled up ahead. So this looks very similar to how Bitcoin looked, and I'll show you the daily chart here soon. Yeah, it just looked very similar. What can I say? I wouldn't consider this bullish at the particular point in time, especially if we start breaking below this trend line. What we need to see happen is silver to recapture the 50 and recapture up here at around $27. Gold is very similar right now, looking a little shaky running into this trend line. I still have to update this chart, but we need to recapture really this 50 period moving average, which is at 1952. So we need to see some strength closes above 1952 to reconfirm this bull market move has more potential. If we start breaking down right here, which is very possible, it's very likely to come down to this low 1800 to 1820 range and then maybe see some bounces right throughout that area. Also, if we break through that, it's very possible, and mind you, it's still not a bad thing to see the price of gold or silver drop like this in a bull market. This is still relatively actually a strong bull market if it even comes down to these levels. It has not tested the 200, so the price action is above it. The longer it stays above it, the higher the 200 period moving average actually moves up, right? Makes sense. Right now it's at 1736. As the days continue, we'll see it continue to move up. So it's very likely if we do get to 200 up here at this previous resistance that we broke out of, there's going to be a lot of strong confluence for support. So if we get down there, that would be a definite buy zone for me. I'm planning on buying just a little bit higher than that as well if we can get down to those levels. And if we recapture the 1950 level and we can hold up there, I'd consider buying some more there at that point too. I don't see that happening in the very near future because to me this looks kind of weak from a technical perspective. It looks like a breakdown's coming. Could be wrong. Hope I'm wrong, but also, I hope that I'm not wrong so I can buy more. You know, it is what it is. Almost forgot, we have to talk about the US dollar. The US dollar right now is looking decent. We had we had a hammer candle on a pullback, and now we're kind of seeing a little bit of a strength move today, not by much, but, you know, up 0.15. It's, you know, a 1/10% right here, 0.16. So it's forming this cup. It's breaking down to this handle. Like I said, if we start getting above this 96.4 or even above this trend line, it could start really pushing the dollar higher. That's going to apply the pressure that we just talked about in gold and silver. It's going to apply even more pressure to the downside in equities. This to me looks like a trend that is basing out to make a move higher in the near future. I don't know how high it can go, but I can imagine that if we break above this fib, there's no reason why we can't go and test 38.2. From that point, I don't know what's going to happen. We're going to have to monitor it and map it out. But as I see it right here, this looks fairly strong, but it's also, keep in mind, bearish context, right? Bearish context. We have the 200 sloping down, the 50 period sloping down. The price action is above it, but the context of the chart is pushing lower. So short-term bullish, long-term trend right now is technically bearish. And always keep in mind, when whatever trade it comes to, you got to know that context is king. Context matters in all the trades. So always keep in mind context. Alrighty, if you're still with me, I'm going to close it off with the Bitcoin. And really what we got going on here is just a weird, you know, we had this bear flag. We broke out to the upside. We mapped out 11.2 as our resistance. Got rejected pretty significantly. Then we said, yeah, right in this area, there's a lot of support. So 10,200. So it's really just been trading within this channel from 10,000 to 11.2. So that is probably how I'll redraw it out. Now, a break above it will be good for the bulls. A break below it is going to be bad for the bulls. Now, the 200 period, it is sloping up. So that's a good sign. We got to monitor this one. Right now, as I see it, this looks like, you know, a hammer candle on a pullback, so we might see a little bit of rip up, but the 50 period is going to act as some sort of resistance. As you can see previously, it really did, and it's curling down to this point. Now, you could draw this out as a potential head and shoulders pattern, you know, with a neckline that's kind of at an angle. I'm not going to do that. I'm just looking at 10,000 as that strong support. It looks like a lot of people step up and buy there. So as I see it right now, we are currently putting in lower highs, right? So we have a high here, a high here, a high here, a high here. So we're stepping down these steps. That is bearish momentum. If we break through 11.2, the next spot to test is 10,000. It looks like we want to head down there, but you know, it's anybody's game at this particular point in time. We will see how this plays out. I don't see a good trade at this particular point in time for Bitcoin, but you know, I could be completely wrong. I'm just calling it as I see it. We have resistance at 11.2 and support at 10,000. We'll see where this ends up. All right, everybody. That is all I have for you on today's market brief that closes off the week. If you haven't done so already, please subscribe to the channel. I work hard to grow this channel and put these videos out and do the best that I can. Hit that like button, engage with it, leave a comment. You know the drill. You know the drill. That's all I got for you. On Saturday, I'll post my weekly scan video, which is going to be looking for some opportunities in the market. And yeah, I'll recap on what took place last week for trading, or should I say this week, because it was this week. All right, I'm delusional. See you later.